Welcome to episode 11 of the SaaS Report. I'm your host, Matt Aird, CEO and founder at Sales Science, and today we'll be looking at quarterly results for Microsoft, and specifically the Cloud Services Division, PegaSystems and Atlassian, who also reported quarterly results last week. And then we'll be taking a look at Perplexity's announcement that they're going to be seeking a fourth funding round for 2024. So we'll take a look at that. And we're going to take a look at a paper released last week by Winning by Design and Jacco van der Kooj, titled AI Won't Just Assist Salespeople, It Will Replace Them. But first, let's get into the news. So Perplexity is seeking another $500 million in funding. This would be their fourth funding round of the year, and they're aiming to raise at a $9 billion valuation. They last raised in June at a $3 billion valuation. According to the Financial Times, Perplexity is on track to generate about $35 million in annualized revenue by the end of this year, which means that at a $9 billion valuation, they're raising at about 250 times revenue. Now, Perplexity has some pretty interesting positioning in the kind of AI space, right? They've positioned themselves as like the AI search engine, or kind of more specifically, as I've heard them talk about, kind of an AI answer engine, right? So the idea is that Perplexity is not so much a competitor to OpenAI and ChatGPT, but more of a direct competitor of Google's. So rather than searching in Google and getting back 10 blue links, right? In Perplexity, you ask it a question and it generates the correct answer, or the answer that you're looking for. So they've had decent momentum. As I mentioned, they're looking to raise for the fourth time this year. They're at 15 million monthly active users, but that still pales in comparison, obviously, to Google and then also OpenAI, who claim ChatGPT has about 200 million weekly active users at the moment. That being said, I don't think they'll have trouble getting funded at a $9 billion valuation, right? Even at 250 times earnings, Perplexity, I think, is well positioned based on the narrative that they've created around it being a kind of a Google competitor as opposed to an OpenAI competitor. I think they've positioned themselves well to continue to generate traction in the market moving forward. Microsoft released fiscal Q1 earnings last week, and that means that we get a look into their cloud services revenue. So this is the segment that includes Azure inside of it, and what we can see is that cloud services for Microsoft grew 20.4% year over year to $24.1 billion in revenue for the quarter. That's up more than $4 billion on last year's Q1 number. That's insane, right? That puts that business at almost $100 billion run rate for the cloud services segment. And this was a big improvement on last year's growth. So at the peak of the kind of SaaS slowdown, which was the middle of last year, cloud services revenue actually decreased year over year. So that was down 1.5% on the 2022 number. But when we zoom out, right, this picture becomes pretty staggering. So they've grown cloud services revenue from a run rate of about 28 billion in 2017 up to almost 100 billion this quarter. That's a compound annual growth of about 20% a year over the last 7 years. On this revenue, they generate about 43% operating margins. So that means that cloud services contributed about 10.5 billion in operating income for fiscal Q1, which is insane. Atlassian shareholders are $9 billion richer after their fiscal Q1 results released last week. So shares were up 19% after Atlassian beat revenue estimates for the quarter. They grew ARR 33% year over year to 4.53 billion. They also go back to positive quarter over quarter ARR growth. So if you remember from their fiscal Q4, so kind of like Q2 for this year, they actually had their first ever quarter over quarter ARR decline, right? That's improved, that's back on track. They did loosen up on spending a little bit this quarter as well. So their investment in sales and marketing was the kind of largest beneficiary there. They increased spend on sales and marketing by about 7% as a percentage of revenue. They also reported a 16.8% increase in the number of customers that pay them more than $10,000 a year. That's almost 47,000 customers total now, up from 40,000 this time last year. As we can see on this chart, their best-in-class go-to-market efficiency metrics are still really strong. So they had magic number of 0.94 for the quarter and had 15.7-month CAC payback. That's down from 19 months this time last year. They're trading at 13 times ARR right now. PegaSystems reported quarterly earnings last week as well, and it's never a good thing when your ARR number is going backwards, and that's the position that they find themselves in. They had ARR contraction in Q3, so that went from 1.1 billion in Q3 of last year to 1.08 billion in Q3 of this year. That's just over a 2% decrease in ARR year over year. ARR also shrunk on a quarter-over-quarter basis as well. So PegaSystems is in the middle of this transition from perpetual license and on-prem kind of deployments through to a more kind of cloud and subscription-based offering. They've driven an increase in subscription-based payments from 56% of revenue in 2017 up to 84% of revenue in 2023, right? So moving away from that kind of more traditional enterprise software model, which is on-prem maintenance contracts, perpetual licenses, more towards a more modern kind of cloud subscription-based billing model. And they're making good progress there, right? So the two guiding metrics that they have for that change in kind of approach is ARR growth and Rule of 40, right? So they want to grow ARR, but they want to do it in a way that continues to generate positive free cash flow. Both of those metrics were fairly underwhelming this quarter. So free cash flow came in at 27.4 million for Q3. That's up slightly from 23.8 million in Q3 of last year, but they only got a free cash flow margin of 8%, which when you combine that with a negative 2% ARR growth rate gives them a Rule of 40 of just 6. Right, so a really bumpy quarter for PegaSystems in Q3. They're trading at 6.4 times ARR right now. Final thing I want to cover today is a post that Jaco van der Kuij from Winning by Design put out on LinkedIn earlier this week. And the title of that report is AI won't just assist salespeople, it will replace them. And in that report, he outlines a number of arguments as to why this is likely to be the case and why it is more than likely going to start in 2025, right, where we're going to see the transition to this happen as soon as next year. Now, the paper begins by highlighting the fact that AI will flip the dynamics or the information asymmetry between buyer and seller, right? So it makes the argument that up until today, sellers have been the ones with the information asymmetry, and so buyers are coming to them for answers to questions, recommendations, and advice. But that because of the rise of AI, this will flip in favor of the buyer, right? They'll be the ones with the insights. They'll know exactly which products and services they need in order to solve their problems, and salespeople won't add that much value to the conversation, right? This means essentially that kind of salespeople are less useful, right, in this kind of post-AI world. Now, the kind of counter argument I would make to this is that, you could argue that that information kind of asymmetry or the switch there has already taken place. You've got more online communities than ever before. You've got more online review sites than ever before. The ability for buyers to figure out, what solutions are in the market that can solve their problems, that is something that I think sellers have been adapting to more and more over the last few years. Is it possible that AI accelerates this shift? I mean, of course, right? If AI gets good enough to be able to come in and individually diagnose the situation within your business and then provide a course of remedies or actions that you should take based on that, and that's perfectly prescribed to the situation you find yourself in today and where you want to get to in the future or your strategic plan, then yeah, I mean, potentially in that situation, there aren't any interactions between buyers and sellers, right? An AI agent just identifies what you need and then goes away and procures it for you. But yeah, I think largely you could make the argument that kind of we are in this situation, or sellers have been dealing with a similar environment now for at least the last couple of years. The second argument that he makes is that go-to-market inefficiency is now the new norm, not the exception. Right now, the argument here goes something like, companies since the boom or the peak in 2022, their go-to-market motions have become less efficient, and there isn't a lot that these organizations can do to turn that around. Right? And as you can see on this chart here, basically what this shows is the decreasing efficiency of a few go-to-market motions at some public SaaS companies. Through this podcast, right, we've looked at a bunch of examples that kind of help to reinforce this point, right? So if you take a company like ZoomInfo and we look at, their growth in Q2 of 21, so kind of right at the peak of, SaaS effectiveness, SaaS efficiency, SaaS public valuation multiples, right? You've got ZoomInfo was generating 57% ARR growth with a CAC payback of, 11 and a half months, right? So really strong growth, really efficient to generate that growth. Fast forward to Q2 of this year, they've got negative 6% ARR growth, and we can't calculate CAC payback because you need positive quarter over quarter, ARR growth in order to do that. Salesforce is another example, right at the top end of town in middle of 2021. They were generating 22% growth with a 26-month CAC payback. Fast forward to today, and that's a 9% growth at 130-month CAC payback. So I think the general premise that he's making here is correct, which is that go-to-market motions are about half as efficient as they were a couple of years ago. The second part of this point, though, is an area that I disagree somewhat, and it is that the reason for this slowdown in go-to-market efficiency, or this decrease in efficiency, is that human sellers are too expensive, they lack the knowledge to provide value to buyers, and they can't keep up with their needs. I'm not sure that you can connect these dots, right? I'm not sure that all of a sudden in the last kind of 18 to 24 months, sellers became more expensive, their ability to have valuable conversations with customers decreased. I'm not sure that we've seen that much of a change in those things over the last couple of years, but where we certainly have seen a change is in kind of the macroeconomic climate, right? So the willingness of companies just to go and spend money in order to generate growth has diminished significantly. Companies have less money to spend, which means they spend less money on software, which means it's harder for software companies to grow. Now, regardless of how we get to this point, you could say that the ultimate outcome is the same, and that is that if go-to-market efficiency has decreased and it's likely to remain decreased, then the only way to improve that, right, if we can't generate more growth, the other way to improve the efficiency metric is to reduce costs, right? And so the report goes on to suggest that that is the best course of action to take. The third thing here he raises in his report is that the go-to-market motion that is designed today is kind of inherently flawed based on two specific kind of metrics, and those are like the scalability and the sustainability of the go-to-market motions, right? So when they talk about scalability, what they're talking about here is basically the form or the way in which we scale go-to-market motions at the moment, which is through hiring, training, onboarding more people, right? Typically, if an organization has larger growth goals or they want to grow at a faster rate, they'll add headcount in order to do that. Inherently, that's less scalable than using some kind of like automated process in order to, to generate that growth or to handle that growth. The second part here is the sustainability piece, and that refers to kind of like the cost associated with the go-to-market engine. You need to have a go-to-market motion that is sustainable in terms of being able to, acquire, retain, and then expand new customers into the business, right? If it's not sustainable, you're never going to generate, net income. If you can't generate net income, then you don't really have a business, right? And so the human capital involved in the go-to-market motions impacts both the scalability and the sustainability of the current go-to-market structures that we have. The argument here is that AI and automating processes is the answer to both of these problems, right? AI is infinitely scalable, essentially, right? All you need to do is just add compute, and you can increase the scale at which you execute. And it's orders of magnitude more sustainable, right? The cost of running an AI agent is obviously significantly less than the cost of employing, training, onboarding, and then eventually like replacing a person, right? Whether that's an account executive or an SDR or account manager. Now, obviously, in a perfect scenario, this is 100% correct, right? If we could design AI that would replace all of the functions that humans currently execute within a go-to-market motion at a skill level or an effectiveness level that's as good or better, then yes, we're going to have more scalable and sustainable go-to-market motions for sure. The thing I think that's missing here is a more detailed explanation of like how that actually happens. At the moment in the go-to-market space, what we've got is AI SDRs, which from all accounts aren't doing a terrific job. And then you've got other AI applications which just help to kind of like streamline processes, right? Whether that's recording a meeting, transcribing, pulling out or summarizing that meeting, maybe automatically updating CRM, that kind of thing. So it's more kind of the automation of routine tasks as opposed to replacing a human entirely. Now, at the limit, this argument I think makes sense. I think the fact that we're projecting this transition to start taking place in 2025 may be too soon, right? I don't know if we've seen enough yet to be able to make the call that this is something that's going to happen in the short term. The fourth point they make is around this concept of using systems to scale processes. They state that revenue production can be broken down into kind of three core components. You've got the processes that you run, you've got the systems that you use to execute those processes, and then you've got the people that you use to kind of drive those systems. And they make the argument that the key to solving the go-to-market efficiency is to focus on refining process and integrating systems to improve that, the scalability and the sustainability elements that we're looking to improve. So the idea here is not to use AI to make people more efficient, but to design processes that don't require human inputs from the beginning, right? Because the humans are the main inhibitor, basically, to the scalability and the sustainability under the argument. So co-pilots are out, right? You can kind of think of those as, I think the way they're thinking about them is like co-pilots are kind of a suboptimal way to solve the problem. Now, I've heard Elon Musk talk about kind of like suboptimal solutions before. It's one of the reasons that, Tesla don't make hybrid cars, right? Is because his view is that we need to go to fully electric. And so let's just go to fully electric and figure it out sooner rather than later, right? Hybrid cars just create this interim where you're not really getting the outcome that you're after, and maybe you get stuck at that step for longer than you should. So pull the Band-Aid off, get away from co-pilots, and let's go fully into trying to automate as much of this as we can. And so we can see in this chart here, right, the idea is to flip the foundation here, going away from people being kind of like the foundation of the go-to-market motion and moving more towards the process as being the foundation. And then the people sit on the top executing, the more strategic or critical parts of that process, right? They also make the argument here that this has been done in other sectors, right? So if you look at modern day manufacturing practices, right, we didn't just give manufacturing employees power tools, right? In most situations in large scale manufacturing, right, those people have just been replaced completely by automation. So the argument here is that we should try to do the same thing with go-to-market teams. Fifth argument they make here is that linear systems can't meet exponential growth expectations. As we all know, startups and scale-ups are, the very best of them are trying to grow exponentially. The problem that they highlight in this report is that they try to grow exponentially, but they try to do that through a linear growth strategy. And so as we talked about before, right, these growth strategies are largely dependent on hiring, onboarding and training more people in order to generate more scale. But because that takes time, effectively you potentially miss out on capitalizing on market opportunities that can come and go, right? If we identify an opportunity, if we have to go and recruit, onboard, train a human workforce, that can take us 12 to 18 months to really get that dialed in. With AI, we could essentially design the program, flip a switch, and we're executing. Now, the pushback I would have against this is that we already see a bunch of organizations that generate exponential growth. And in fact, we've seen a lot of that happen just in the last few years, right? So a bunch of companies have, set new records for, reaching $100 million in ARR faster than ever before. So you've got companies like Ramp, Deal, Wiz, Slack, right? They've all gotten to about 100 million in ARR in kind of less than 24 months, right? How were these companies able to do that before AI? Well, it's because they've got really good product market fit, right? I don't think, and I'm not sure that the report is making this argument, but you could read this argument as, look, if everyone just deploys AI, everyone will be able to grow that much faster. I don't think that's the case, right? You really need really strong product market fit. And then I think an element too that these companies had is that they've got some form of PLG growth. Right, if you've got really strong product market fit and you can design some kind of product-led growth motion, you've still got the ability to grow really fast today. Would these companies have benefited from AI? Would there be some advantages to scale if they had kind of this, utopia kind of AI stuff in place? Yes, I think so, but does it impact the majority of companies? I'm not sure, right? I think maybe the limiter in most situations isn't just necessarily that you have to, hire and train and onboard a team, but it's often that there's kind of a mismatch between what you're trying to take to market and what the market wants. So then in the next sector of the report, they try to paint a picture for what AI kind of can and can't do, right? And the way that they explain this is kind of breaking down tasks into three levels. The way they do this is through the analogy of building a road, okay? So they say that, there are simple tasks in road building, and that might be like fixing potholes. And then you've got intermediate tasks, and that might be like building a new section of road. And then you've got complex tasks, which might be like building a large bridge, right? And so they say that there are ways that you can leverage AI in each of those situations in order to deliver more sustainable and scalable go-to-market outcomes, or in this case, right, more scalable and sustainable kind of like road building and maintenance. And so the outcomes that we're trying to drive here are, we want to do it either cheaper, which means more sustainably. We want to do more of it, which is, more scalability, or we want to do it better, which improves kind of like durability of the business. And the way that they want us to visualize that is to kind of map out the current go-to-market processes on a chart, right? So if we look at this chart here, basically what we've got on the x-axis is the consequence of failure, right? So what happens if this process goes wrong or it doesn't work? And then on the y-axis, you've got the human oversight ratio, which is how many AI processes can we execute per human overviewing them, right? And so the way that this chart works is that effectively you've got the go-to-market motion scaling from SDRs through customer support, through account management, through account executives, to sales engineering, all the way up to a go-to-market architect. Okay, and so the idea here is that AI, the degree to with which AI will be trusted to execute the entire process will be higher at kind of the lower left portion of the graph, and humans will be much more involved at kind of the top right-hand corner, right? Which is where, an AI and a human may work side by side, and, the human will be signing off on basically every decision that an AI makes. Whereas in the lower left section around, where the SDR is working, you may have one SDR monitoring the equivalent of let's call it 100 AI activities or agents. And the idea here is just fairly simple, which is the higher the cost of failure, or the consequence of failure, sorry, the more we want humans involved, right? Because we need there to be some accountability within the organizations to say, okay, well, this was a really important strategic decision, who signed off on this? And that's why when it comes to questions okay, how are we going to design the go-to-market motion? What is the strategy? Those kinds of more, go-to-market architect decisions, that'll be done with a human kind of approving everything. The way that you personalize a cold email or something that an SDR might execute, that's something that might be left obviously to the AI's discretion. Now the final point I want to cover from the report is that this concept of all roads to success lead through systems and processes, right? So the idea here is that AI added to a suboptimal process will just create bad results faster, right? Or potentially even worse results than we would have got if we had humans executing it. And I think where you would put that at the moment is that, with the current iteration of AI in sales is kind of that AI SDR space. I think currently what you've got is just these AI agents executing more bad outreach into the space. And what you see is response rates across the board are coming down, right? So that's an example of, AI being deployed in a way that isn't strategic or well thought through, and it kind of, it generates a worse impact than you might get if humans were executing the process from the beginning. So the key thing here that they want to get us to think about is, how do you design the systems and the process to work first? So how do you, design something that is working or is going to work? And then how do you bring AI in to replace humans in as many situations as possible, right? So think about that as, developing the systems and the processes and then training the AI, as opposed to, developing the systems and the processes and then training people to execute those activities or those tasks. And so the interesting thing I think that this opens up is that you've potentially got the ability to have a wider selection of the go-to-market motion that you select, right? So what we see in this chart here is a chart from Winning by Design, which outlines the recommended go-to-market motion based on the average contract value for you in year one of a contract term, right? And it starts, at less than $1,000. Obviously, the recommended go-to-market motion is self-serve PLG type motion, right? Through to, between 10 and 100,000. You've kind of got a two-stage outbound motion, right? Where you have SDRs and AEs going outbound at high volumes to try to generate sales opportunities, right? And then in the bottom right, you've got, really kind of targeted named accounts between $1 million and $10 million a year, where you're going after named accounts, you're doing it through network, you're going account by account, you're taking a much more strategic approach to business development. And so the idea here is that if you don't have to have people to execute this process, then it's potentially possible for you to run like a two-stage outbound approach to under a motion where you're only making or charging, let's call it, $50 a month, right? Because you don't have humans that you need to pay hundreds of thousands of dollars a year to in order to execute that motion. And so it allows you to design the motion based more so on like how the customer wants to buy versus having it dictated to you by the price at which you sell your product. All right, so the high level kind of concept here is to move to this process called AI-led growth, or AILG, right? So it's a term coined by Amanda Carlo from OneMind. And the idea here is to not just to do more, but to do more and better, right? So you could think of a situation in which, your go-to-market organization is only targeting the right customers at the right time, engaging them in meaningful conversations that really add value to their process, arriving with insights that are pre-prepared based on their existing or their current situation where they want to get to, and then being able to respond faster to queries, right? You can imagine an AI is available to talk whenever the customer wants to, so they're not waiting on kind of delays in communication or waiting days to get meetings set up, and you've got the ability to offer like transparent and consistent information whenever they need it, right? So this isn't just about improving the speed with which we do something or improving the volume with which we do something, but it's like delivering better buying experiences to the customers, putting them or giving them all of the information, all of the advice, all of the guidance that they might need, right? So everything that you'd want out of kind of the best enterprise or field salesperson is having that person be able to be involved in every customer conversation, regardless of whether you're selling something that's $10 million a year or $10 a month. So the paper makes the argument that this transition begins in kind of 2025, and that the companies that get here fastest will have kind of this like unassailable, market dominance. You could imagine a situation in which that is correct, right? If you've got kind of the perfect go-to-market motion mapped, you can reduce sales and marketing spend from, let's call it 40% of revenues down to 5% of revenues, invest all of that money back into product development. You're probably going to be in a situation which makes it hard for others to compete. The main kind of question I have no doubt that this is on the horizon. The question I have here is like the timeliness around this. ChatGPT's been in the wild for a while now, and I'm not sure that we've really seen a ton of high quality kind of outputs from that in the go-to-market space, right? As we've talked about with your AI SDRs, we've got some kind of nifty automation or augmentation type solutions. I'm not sure how far away we are from that becoming a reality, right? Do I think it will happen? Yes. How far away are we from it? I'm thinking it's probably further than 2025, right? I think these things will take a while to be adopted, especially by the rest of the market, but who knows, we could be there kind of sooner than we think. So if you're a salesperson today, what do you need to do? I think what you need to do is think about how you move up the stack, right? So if we come back to this chart, it's like, how can you move further up and to the right? Because there is going to be, fewer and fewer people required every year in that kind of like bottom left quadrant. So you need to kind of move up and to the right of that curve to make sure that you're in a position where, you're set to benefit from the rise of AI rather than be replaced by it. All right, that's it for today's episode. Thanks a lot for tuning in. As always, if you have any feedback, comments, questions, feel free to hit me up. I'll see you next week. Until then, goodbye.